WTI appears to be ending the week higher than last week, with markets ending 4 weeks of uncertainty for the commodity's next leg. Oil traders appear to have decided on oil's next direction, with economic recovery prospects in China increasing. An apparent increase in oil demand combined with a reduction in oil production in the US appear to have provided some clarity for oil traders. In the report, we aim to shed light on the catalysts driving WTI's price, assess its future outlook, and conclude with a technical analysis. According to EIA, production in the US fell by an estimated decrease of 1 million barrels per day, representing an estimate of impact of winter storms and extreme cold temperatures. The reduction in production due to weather events could restrict the supply of oil and as such could have aided oil prices to higher ground. Should the extreme weather phenomena continue in the US and continue to hinder oil production, we could see oil prices being supported and vice versa. On another note, the US crude oil inventories pointed to a significant increase in oil demand during the past week, with the API weekly crude oil inventories figure reporting on Wednesday that crude oil inventories in the US decreased by -6.674 million barrels, which is much higher than the expected drawdown of -2.4 million barrels. Moreover, the EIA weekly crude oil inventories figure indicated a greater drawdown that was expected by coming in at -9.233 million barrels versus the expected figure of -2.15 million barrels appeared to confirm the API figure of an increase in demand for oil. As such, with both figures appearing to validate the increase in oil demand, it may have translated to higher oil prices. On another note, the Baker Hughes oil rig count, which was released last Friday, continued to decrease, with the total oil rig count coming in at 497. There are two scenarios that might be in play with a declining oil rig count. The first being the efficiency from existing oil rigs may be increasing, and as such the existing oil rigs could increase their oil production, which in turn could support oil prices in the long run. The second scenario could be that demand for oil may be decreasing on a macro level, so should the reduction in total oil rigs continue, it could weigh on oil prices in the long run. According to Reuters, China's central bank announced a deep cut to bank reserves on Wednesday, a move which the article claims will inject approximately $140 billion in cash into the Chinese banking system. The potential cash injection into the economy could kickstart economic recovery prospects for a nation whose economic activity has been underwhelming ever since COVID measures were lifted. As such, with the potential strong message being sent to the markets, the government will protect the economy. It could lead higher demand for oil from the world's largest importer should economic activity pick up. Therefore, the expectations of oil demand from China potentially increasing could provide support for the liquid gold price. Looking at WTICash 4-hour chart, we observe the price action appears to be moving in an upwards fashion, with the pair now appearing to have broken 4 weeks of market indecisiveness. We maintain a bullish outlook for the commodity, and supporting our case is the RSI indicator below our chart, which currently registers a figure of 60, implying a bullish market sentiment, in addition to the formation of an upwards moving trend line, which was incepted on the 17th of January. For our bullish outlook to continue, we would like to see a break above the 78.35 resistance level, with the next possible target for the bulls being the 81.65 resistance ceiling. On the other hand, for a bearish outlook, we would like to see a clear break below the 74.5 support level, with the next possible target for the bears being the 71.10 support base. Thank you for joining us today as we navigated through the dynamic world of financial news. From all of us here at IronFX, we wish you a solid trading.